Hello, this is Margie Russell, Executive Director of NYARM, New York Association of Realty Managers. The New York Association of Realty Managers was created in 1958 to serve the needs of building management. At that time, primarily apartment building management. However, we have transformed ourselves over the years to cater to both commercial, office, and multifamily housing. One of the great accomplishments of NYARM is its creation approximately 30 years ago of its New York Accredited Realty Manager Certification, which is widely recognized in New York State, New York City, and the suburbs. Today, we will be hearing from Jay Hack, an attorney and partner with the law firm of Gallant, Dreyer, and Berkey. Mr. Hack chairs the firm's banking and financial institutions practice. With reference to his position with the New York State Bar Association Business Law Section, he is an executive committee member and former chair. He is the co-chair of their Wine, Beer, and Spirits Law Committee. He is a member of their Banking Law Committee. Mr. Hack today will speak about the most current legal information on the present banking crisis. This is a video created from a webinar attended in the last several days. I turn it over to Mr. Hack.
So let's jump into this and let's talk about FDIC insurance coverage as it relates to money that you are holding for buildings. Generally, it's a little different than lawyers, but not from the FDIC insurance point of view. You're maintaining principally operating accounts. You may have capital accounts that are segregated for the purpose of making capital improvements, but it's all money that you expect to disperse in a relatively quick period of time. Legally, you are what is called a fiduciary. That means it's not your money, but you owe a very special duty to the person whose money it is to safeguard it and spend it only for their benefit, and in your cases, as they direct you to spend it. Now, they may not direct you to spend it, say, spend $50 on payroll and this, but they'll say, you got to disperse it for our payroll purposes. You got to spend it for this and spend it for this in general categories, and then you spend it in accordance with their direction. You are what is called a fiduciary. That means that even though the account might not be called a trust account, legally, it is a trust relationship. And that is extremely important when it comes to FDIC insurance, because unless you are only managing money for one building, what I'm about to say is the critical factor. When it comes to FDIC insurance, the amount of insurance, let's call it the $250,000 limit, is measured by beneficial ownership interests, not by fiduciaries. Therefore, in the simplest example, if you have two buildings and you collect rent on both buildings, and it doesn't matter. I'm not going to deal with the question of whether you have to have two accounts or one account. That depends upon a lot of different things, but is not relevant to the FDIC insurance issue. If you have two buildings and you are keeping money for two buildings, and you satisfy certain requirements that I'm going to talk about, because those are the action items you got to make sure of, then you have two different insurance limits, one for each building. You can't have $400,000 from one building and $50,000 from the other and say, I got $450,000 worth of insurance. That doesn't work. Nice try. That's a lawyer's loophole. They tried, they asked, I said, come on, guys. but you do have $250,000 of insurance for each beneficial ownership interest. Now, what do you need to do? And this is, I'll give you the action item up front. I know that's a horrible thing because then people will leave and rush and do the action item, but trust me, you need to know this and you need to think about this throughout this discussion. There are two fundamental things that you must do. Number one, you have to tell your bank that the account is held in a fiduciary capacity. Now, the fact that you title the account, who should I use as the I was going to say related management only because he's in the upper left corner. The fact that you title the account related management, comma, 83 Fifth Avenue building account is not necessarily enough. It should be enough, and it will probably be enough, but the FDIC unfortunately has some extra discretion that I really don't like. But I would, they have a rule which indicates that the title of the account is an important indicator, but it's not conclusive. So action item number one, make sure not only that you have titled your account in an appropriate manner, but that you have advised the bank in writing that you hold that money as a fiduciary for one or more buildings. That's number one. I don't, by the way, I've got fiduciary accounts all over the place, and I had a bunch of about, I think the number was $900,000 at Signature Bank. So needless to say, this is important. The rule for lawyers is a little bit more flexible in that if I specifically say Gallup Dreyer and Berkey attorney escrow account, that's good enough to under the rules to constitute notice to the bank, and notice, the more important idea is notice to the FDIC when it comes in and takes over the bank, that there might be more than one insurance limit, even though the account is, my account is more than $250,000. If you, in certain circumstances, real estate managers are permitted to commingle. In certain circumstances, they are not permitted to commingle. That means keep money from two different buildings in the same bank account. In most, if not all, residential management situations, I believe you are not. Some commercial situations you are. I'm not dealing with that. I'm not going to talk about when you can and when you can't. If that becomes important, we can write about that. It requires a review of a lot of statutes, a lot of attorney general regulations, which I started to do today, but wasn't able to finish this morning. But you must make sure that the bank knows not necessarily whose money it is, but at least that it is a trust account. Whose money it is the second standard, but that's a little bit more interesting and a little bit more, you got more flexibility. Just if I am at a building, and I've suggested to my partners that we notify all of our buildings and we include in all management agreements that not only should the manager of the building advise the bank in writing that it is a fiduciary account, but then they should get some confirmation from the bank, or at least give the building proof that they've given the notice to the bank. Because if the manager says, yeah, I notified the bank, but they didn't actually notify the bank, it is at best up in the air. Depends upon things like the title of the bank and other information that the bank may have. So my recommendation to the managers is just write a letter saying, please be, how many banks are you going to use? Maybe 2, 3. unless your building has a friend because the president of a bank happens to live in one of your buildings and insists that the money be there. You're going to have a couple of buildings. That's fine. You're going to write a couple of letters that are to your account rep. It's going to say, this is to confirm and to make sure you understand that we're holding these funds as a trustee for various buildings. And by the way, that is separate from your own company's insurance limit. So if you have 3 buildings and you have an account covering 3 buildings and you have your company's own account, that's 4 times the insurance. The buildings don't use up yours and you don't use up theirs. The second remind me, in case I forget, I'm going to talk about, well, actually, let's do it in this order. There is, however, one problem with that analysis, which is not your problem. You just have to give notice. If you maintain your escrow account at, or your trust accounts at, let's say, Citibank, and you have $250,000 in your trust account that is beneficially owned by 845 3rd Avenue Corp. That happens to be my address. That's an interesting issue because I wasn't even thinking about it. I just pulled a number out of the air. 845 3rd Avenue Corp. And 845 3rd Avenue Corp also has its own account at Citibank. Those 2 numbers are added together. It's so I'm going to talk about an attorney escrow account just because it's easier to understand because I hold money for human beings. If I have an escrow account and there is $400,000 in it, $200,000 is owned by John Smith and $200,000 is owned by Mary Jones. And John Smith also has a personal account at the same bank for $100,000. The $200,000 that I am holding and the $100,000 that he is holding personally in his own name at the same bank get added together, and it's only $250,000. What does this mean? And this is an attorney general position that they raised probably about 6 or 8 years ago in a co-op offering plan where we were working on the offering plan. The attorney general wanted us to specifically disclose that issue. It was very sophisticated. I did not expect them. One of my partners came rushing into my office and I said, who the hell he said, who figured this out? I said, see, you got a smart guy who probably used to work for a bank and got kicked out and went to the attorney general's office. But the solution to that, and the attorney general requires this in offering plans, is you just have to notify the people whose money you are managing as part of the building management where you put your escrow account. And I would suggest that you also notify them that they need to add, for FDIC insurance purposes, if they're worried about that, and they shouldn't, but that's another issue. For FDIC insurance purposes, they need to add any of their own money to the money that you are holding for the same beneficial owner in that bank for the purpose of determining their insurance limit. Now, please note, it is an entity by entity or building by building or person by person calculation. So if you are holding $200,000 for 845 3rd Avenue Corp, and the president of 845 3rd Avenue Corp has an account in his own personal name, and all of the, in the case of a co-op, every single resident of the co-op has an account at that bank because that bank happens to have an office in the ground floor. That doesn't matter. John and Mary and their personal accounts are not aggregated with the corporate account. there's an exception for that only when the corporation is formed, doesn't actually conduct any business, and it's sort of just formed to increase the insurance limit. You can't do that, but you're not in that business. So it's really not relevant to you. And I've actually never even seen the FDIC make that claim, but there is a rule that prohibits that. So let's call it your action item number 2 is let the companies that for whom you hold money know that you are holding money for that company in that bank, and therefore that may be aggregated with the insurance limit. And if they're worried, I see it. So your second action item is notify your buildings where you keep your fiduciary accounts. And I would also give them, I mean, you can use this as this is a marketing and competency tool that you can sell to them. Hey guys, we wanted to make sure, and we have done, we sent notice to the bank. If you really need, if you have eggheads on your board, on the board, the citation to the rule is part 300 of Title 12 of the Code of Federal Regulations. I think it's it's section 8. It's somewhere between 7 and 10, but I'm not sure if it matters. I'll give you the exact number, but you can tell them, look, we've given them the notice, we've done this, here's the rules. If you you should make sure that if you have any entity money in the same bank, it adds up. But we've taken these steps to increase or make sure that your insurance limit is not mucked up by the insurance limit for all the 952 other buildings that we manage. There's your second action item. Your third action item, and the most difficult, but probably not for you guys, is there must be records of who is entitled to how much money. In other words, if the FDIC takes over the bank and they come in and they try to figure out how much money, how much insurance coverage there is, somebody has to have records to show if you have principally, going to be relevant in the case of commingled accounts, in which I have, let's say, I had its signature. I had in one account $600,000 or $700,000, but my bookkeeper had separate records. The key language in the rule is kept in the ordinary course of business, which they were, that show that John had $100,000 and Mary had $50,000 and Joe had $125,000. Those records do not have to be at the bank. This is the biggest surprise, but I don't know actually why the FDIC made that decision. I am friends with the guy who negotiated it, but he had quadruple bypass surgery about a month ago, and I haven't been able to get him. But I suspect it was just because they didn't want the bank to have to deal with the pain in the ass of keeping those records. So long as you have those records, as the fiduciary that shows whose money, what the breakdown of the money is, that's good enough. If you don't have those records, you're probably shooting yourselves in the foot for other reasons, because how do you know, how much money you can spend for building A, and what happens if building B says, write a check to pay for our new whatever, and you got to know how much money building B is entitled to spend. So it is unlikely to be a problem, but make sure that you have clear and unequivocal records that you keep in the ordinary course of your business that shows who is entitled to each share, to what share, not each, who is entitled to what share of the money that you are holding. That is the second and most important action item is when you leave here, you go back and make sure that you have those records and they should be up to date. The bookkeeper saying, yeah, I'll get to the bank rec and all that banking stuff next month because because we get rent money and we collect rent money and I got 5,000 rent checks and I got to separate them and I haven't had time to do that. And that's okay, but only if the bank doesn't fail before you get a chance to do it. So my strong recommendation is, and I hate to say this because it's kind of the panic approach, but my strong recommendation is make sure that those records are up to date on a regular basis. Because when the bank closes, if a bank closes, you're not going to want to have to stay up all night scurrying around bringing your records current and then claim that they were kept in the ordinary course of business 3 weeks ago. Now, I will tell you that this and the need to do this and all of the other related issues are, for lack of a better term, panic related. The biggest problem, is another bank going to fail? The answer is certainly shouldn't. Jamie Dimon and friends just put $30 billion into First Republic Bank as deposits to let everybody know that they had faith in First Republic, which was not nearly as dumb, but still dumb compared to Silicon Valley Bank. They just put $30 billion into it. For those of you who are familiar with what JP Morgan, the human being, did when those two guys tried to corner the silver market and the world economy almost collapsed about 115 years ago. Jamie Dimon may or may not have been the moving force behind putting the money in, but I think 5 banks, JP Morgan, Wells, B of A, Citi, and one other, I think, deposited $30 billion. And I really want to sit down and say to Jamie Dimon, what happened? You were channeling your predecessor, JP Morgan, when he did exactly that in, I think, 1908. And what happened in that case was, and for those of you who've been at the Morgan Library, you can go to the room where he did it. He called in the 5 largest investment bank, the presidents of the 5 largest investment banking firms are in the United States. And they sat in the room and Morgan said, okay, you're going to put in this and you're going to put in, this was not a negotiation. It's not the way he operated. He said, I've calculated what is necessary to save the world economy, and you're going to contribute this much and you're going to contribute this much. And he told each of the people in the room how much money they had to put up. And he could intimidate people, as I understand. And that is exactly what they put up, and they saved the world economy. And I suspect that that is sort of what just happened. I think it was yesterday. So I do not believe that if we can avoid panic, that's the only real problem we have left. And I don't think, that's what I've been doing. I've changed my title from lawyer to fireman. And I'm trying to put out fires and avoid panic. And I've talked to a lot of bankers, and every one of them tells me the same, and not just in New York. I've talked to bankers in Oklahoma and Texas, a couple of other places where I've got good, in Tennessee, Jerry, and everybody says, nah, our customers aren't panicking. We're not getting significant withdrawals. If necessary, we'll sit down with our large deposit volume customers and we'll go over our call report, and we'll show them how we weren't stupid like Silicon Valley Bank was, and everything's going to be okay. And I believe that that's what's going to happen, but that everything will be okay. But from your point of view as a what do you want to call it? From a marketing point of view? I mean, you're in business. You want to convince your customers that you're doing a good job and that you have their best interests at heart. And from that point of view, yeah, go ahead and tell them what you're doing to maximize their deposit insurance. I mean, I haven't actually dealt with a deposit insurance claim, a real deposit insurance claim on a failed bank since they closed, what was it called? It was a bank out of Puerto Rico. And I made $5 billion worth of claims on behalf of a client. It's not going to happen, but from a marketing point of view, you can market this, and you can tell people that you care about them, that you are at the head of the curve, not behind the curve. You are not acting retrospectively. You're ready for this, and everything is going to be wonderful. Is everything going to be wonderful? I think so. Other than the fact that we will call this the statute that they inevitably enact, the Lawyers Relief Act of 2023, because it's going to give me a whole lot of work. Because it happens every time, when Dodd-Frank gets adopted, I'm up all night reading 650 pages of statute, and then I'm, unfortunately for them, billing all these clients about teaching them about it. But I honestly believe we're not going to have a problem. Now, other FDIC insurance and related questions, which inevitably get asked. How quickly can I get my money if a bank fails? Do I need to have money in two separate banks in case one of them fails, so that we can continue operations out of bank number two while they resolve the problems with bank number one? The answer to that question is, it doesn't hurt, but it is extremely unlikely to matter. Why? Because in virtually all cases, the FDIC pays out $250,000 to everybody, or is willing to pay up to $250,000 to everybody on the Monday after they close the bank. The truly astounding thing to a bank person, somebody who does this a lot, was that they closed Silicon Valley Bank in the middle of the day on Friday. The last bank, they always close the bank at the close of business on Friday. They come in at 3 o'clock or 5 o'clock, depending upon how the bank operates. They slap a sign on the door that says, oops, this bank was closed by the state regulator or the controller of the currency for national banks, and the FDIC has been appointed as a receiver. Show up Monday morning and you can get your money, and don't try to use your ATM card over the weekend. Those are the two things they generally say. But in this case, they closed it at noon. Actually, I'm not sure it was exactly. They closed it in the middle of the day. And the reason they closed it in the middle of the day is that this ain't, 1995, and there are too many electronic ways to withdraw money. And the word I have not been able, it is not verifiable at present, is that if Silicon Valley Bank had stayed open until 5 o'clock, they would have had no cash left, zero. They would have had to default on their obligation to pay withdrawals, so they had to shut them down. Why did they close Signature Bank? That's a question that I believe is answered politically rather than economically. A number of people, notably including my friend, former regional director of the FDIC, who specifically made me swear that this is not for attribution, but by the way, you can probably figure out who it is. They closed Signature Bank because of the potential for panic and fallout at other banks starting on Monday morning. That Signature Bank probably could have withstood a run on the bank and massive withdrawals because their balance sheet was not as wacky, for lack of a better term, as Silicon Valley Bank. They closed them because they were afraid that if they didn't, there'd be lines out the door at Signature branches on Monday, and that would cause lines to be going out the door at other banks, and it would spiral. But in all these cases, they close on Friday with the expectation that they're going to reopen on Monday and that they're going to pay withdrawals on Monday. Even in the Signature case, where they didn't close it until, what happened was there was a meeting in Washington with all the big muckamucks from the, it was a Zoom. As a matter of fact, I did find that out. All the big muckamucks from the bank regulators, the federal bank regulators, plus, interestingly enough, the what's her name? Sorry, I'm drawing a blank. It's like a moving target. The superintendent of the Department of Financial Services of the state of New York, who was the only state regulator present at the meeting, sometime Sunday afternoon, they decided to close Signature Bank, and they still permitted withdrawals on Monday morning. They acted that fast. Now, there were some glitches. I got asked a lot of questions about, well, I represent a land by lawyers, but it's also going to be relevant to you. I represent a landlord, and the landlord has taken a letter of credit as security, as a security deposit instead of cash as a security deposit. Is that letter of credit going to be paid? We immediately contacted senior vice president at Signature and posed the question and said, you should have already gotten our news release that said blah, 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 and that it's business as usual. We're honoring all obligations. And my response was, yeah, John, I got the news release, but I've written hundreds of those news releases. I'm asking you the specific question because I don't want to deal with the artfulness of the language in the news release. Are you going to pay letters of credit? And the answer was yes. There was a little glitch in the wire room at Signature for people who tried to wire money out on Monday, but all wire. And the reason for the glitch, I've had a couple of explanations. I honestly don't know for sure. It could be that the guy who's in order to send a wire, two people have to press a button. It's like a nuclear attack. And it's possible that that the people authorizing wires weren't sure of the answer, which is that they were going to send, which I would expect if I was a 4th or 6th tier officer at Signature, and my entire life had just gotten put on its head or tossed on its head. So there were not all wires went out. My office tried to wire out some money. We have a direct wire with a little electronic dongle on a computer plus 2 people with passwords. Those went out, but there were, I've been told by at least 3 lawyers that by Tuesday at 2 o'clock, there were some wires that had been hung up, but by the end of the day on Tuesday, they were all sent. Can you write checks on your account? Everybody says, not everybody. The people who really think this through say, wait a minute, I understand there's this Signature Bridge Bank, and it's not Signature Bank, it's a new bank. And can I write checks on use my existing checks, which are drawn on Signature Bank and have the Signature Bank routing number and all that? Are they going to work? And the answer is yes. The government has figured that out. They've done this before. The checks worked. ATM cards we didn't actually have an ATM card at Signature, so I couldn't test it. I already long ago cut them all up because ATM cards, you should never have one for, by the way, lawyers can't have them. I would recommend that if you have any ATM cards for money other people's money that you're holding as a fiduciary, you cut up the cards and do not use them, because you want a paper trail to cover your own butt. You don't want an ATM card and then someone takes it and uses it and you have no adequate paper trail, because embezzlement is a cottage industry in the United States among bookkeepers. I hate to say that, but it's true. But ATM cards worked. It's a little bit trickier, but the system has gotten better. 15 years ago, 20 years ago, they didn't always work, but this is all anticipated. And you could use your ATM card. Lines of credit are still good. Credit cards are still good. Maybe there's a one-day glitch, but what does this mean? You got to divide your money so that each building has uses two banks? The answer is no, you shouldn't have to do that. If you want to do that because your own infrastructure at your firm is such as that would allow you to do that seamlessly, I'm certainly not going to say don't do it, but is it necessary? I think the answer is no. Margie, how come I don't have like 173 questions?
So, Jerry, you being from a full banking background.
Yep. One question, Jay. Let's say you got your accounts at Citi, and as an individual, and you got a savings account 1 and savings account 2, and you got under $250,000 in both of those, or let's say you're at the max, $250,000 each one of those accounts.
Separate ownership interests. If you have 3 accounts in the name of Jerry Niemeyer, that they get added together. If you have 1 account in the name of Jerry Niemeyer, 1 in the name of Mrs. Niemeyer, and a joint account in the name of Jerry and Mrs. Niemeyer, that's 3, because that's 3 different legal ownership interests.
Got it.
But with the exception of a legal entity, a corporation, a partnership, whatever, that is not engaged in an independent business activity, which is the only exception, it is by individual business, individual beneficial ownership interests. Now, partnership raises an issue, but not anymore. I was asked the question, if I have a partnership and there are 15 partners and the partnership has a deposit, is that 1 ownership? Is that 1 insurance limit or 15 insurance limits? Now, that question was asked by, sorry about that, I gotta hang up. I forgot to disconnect. That question was asked by an attorney who's older than I am, and he was thinking it used to be that a partnership in New York was not a separate technical legal entity. And as a matter of fact, for those of you who've been around a while, you may have seen deeds that say John, Mary, and Joe, as co-partners, which is no longer used as a title. There used to be a question. I don't even remember whether it may or may not have been resolved by the time I started practicing law in 1976. There used to be a question as to whether individuals, whether a partnership was a separate entity or whether it was just 4 people deciding to work together. A partnership is a separate legal entity. It gets 1 bit of insurance. If it has 5 partners, they have their own, but the partnership has only 1. And It has nothing to do with the number of accounts. If there's Jerry 1, Jerry 2, and Jerry 3, and Jerry is the same person in all three, and it is Jerry only, that's one insurance limit, because that would be like a loophole big enough to drive a small asteroid through.
Very good. The other thing you were talking about, how JP Morgan and others may have pumped funds into Republic. I'm thinking about the days when Countrywide was in trouble, and they asked Bank of America to, can you please take this over? And Chase took over WAMU. I don't remember what happened at Chase and WAMU, but I'm definitely familiar with what happened at Bank of America and Countrywide. Not only did they buy it, but they also bought all the troubles with legal claims against Countrywide. And that may have been a little hesitant, yes?
Let's just say my friend Marge Gross, who was the general counsel to the FDIC in Washington at the time, she has a slightly different story about what really happened and who wanted to do what. So, and she was in the room. She was the one who negotiated on behalf of the government. And they knew, according to her, they knew what they were buying, and they knew about the troubles and the risks. But yeah, there's some interesting questions. Silicon Valley Bank has gone up for auction. I don't know whether there's been, in addition to the normal negotiations, there's been at least one auction, and there may have been two already. I'm not sure whether the second one was held last night or not. The government didn't want to sell Silicon Valley Bank to Citibank or JP Morgan, and they excluded them from the bidding process. I understand politically why they did that, but it was really stupid because, I mean, you need a couple of bucks to be able to buy that bank, and it was a huge bank. It wasn't a huge bank 5 years ago, but it blew up in terms of size, not in terms of destruction. It blew up its size very quickly. It did not, by the way, blow up its size in 6 months or a year, which is what people are claiming. It went from 60 billion to 230 billion in, it's hard to tell because the way the call reports are written, but roughly in 3 years to 4 years. But no, you can't. It's going to get sold, and so is Signature. They're negotiating a merger. I will tell you, and I made this offer yesterday on Tuesday to 750 lawyers. I said, hey, guys and gals, let's all get together and buy Signature. I said, would you buy Signature for $1? I certainly would. I mean, I can't because of the funding needs, but other than the funding needs, I'd love to own. I'd buy all the stock outstanding of Signature Bank for $1. You'd have to be crazy not to. So yeah, there will be a successor. There's undoubtedly will be a successor. It will assume all the liabilities. That's a guess, but there may be what's called a loss sharing agreement. There used to be a procedure. It's actually how I met the regional director of the FDIC, the former regional, who I was on the phone with most of the weekend. Was we did a deal back in the pre-flood days, the one that Noah was involved in, there was a loss sharing agreement in which the FDIC agreed that they would take the first X number of dollars of losses that the bank experienced as a result of credit quality problems. The reason why they did that was they had to slam the deal through really fast. They wanted the deal to go through, and I represented the purchasing, let's call it purchasing bank. And we couldn't do due diligence, so we didn't have the opportunity. We didn't have enough time. You could review all these loans and decide which ones are a problem, which ones aren't, and give them back to the FDIC, but that takes time. And we had a week or so. And you can't do that in a week. So the FDIC agreed to backstop losses. I think in that deal, it was only $29 million, but it was in the 1980s. $29 million was a lot of money in 1980. There may be loss sharing agreements with Signature regarding bad loans. There may be funding agreements with respect to providing funding in case when the deal goes through, there's a run on Signature. But generally, I'd buy Signature for $1 tomorrow morning if I could deal with the funding issue, because it's worth a lot of money. One of the questions that gets asked a lot is, hey, how about this $250,000 limit getting lifted? Do I really not have to worry at all about this trust accounting and making sure they have notice? Because that was totally irrelevant on Signature and totally irrelevant on Silicon Valley Bank, because they lifted the limit and there was no limit, and it didn't matter whether Joe had $5 million or $50,000, he got it all. I'm not going to talk about the political implications of that issue and whether they should or shouldn't have done it, and with respect to the venture capital firms that caused this mess in the first place. But one of the things, and now I'm sort of morphing into the second half of this agenda, which is legally, how did they do it and why did they do it? And the answer is, in Dodd-Frank, the federal government was given the authority to do certain things with respect to what are called SIFIs, systemically important financial institutions. In other words, and the government had a lot of regulatory authority over SIFIs. And you may have heard the stuff about living wills and how a systemically important financial institution has to prepare what's called a living will, which has to be reviewed by the federal government to determine whether or not they can survive and what they will do in the event that they have a problem. You've probably heard about, if you've been reading the newspapers, I don't even know if they're newspapers, but if you've been reading your Yahoo news feed like my wife, you've probably read about the fact that Silicon Valley Bank lobbied heavily for a certain number to change from 50 billion to 250 billion. That number represents the point at which you were deemed to be a SIFI, a systemically important. And Silicon Valley Bank was under the limit, and therefore they didn't have to do a lot of this stuff. So the question is, if I don't want to pick a bank because I've represented most of the small ones over the time, but if, your hometown bank, which has total assets of $1 billion, which sounds like a lot, but it's a peanut from a banking point of view, fails, is the government going to exercise the same authority? And are they going to lift the limit? And do you have to worry? And with great reticence, and don't quote me on this, we don't know the answer to that question. We certainly don't know the answer to whether they're going to lift the limit. And we haven't had a chance, because everything is moving so fast, to even review the question of whether they have the legal authority to lift the limit. Now, what the Federal Reserve has done is that they have created a credit facility for banks so that banks can go to the Fed and borrow money even against certain long-term assets when they need it for cash and liquidity. However, the press release that says that says that the credit facility will make funds available to eligible institutions. I haven't had a chance to read everything that the Federal Reserve has written on the definition of an eligible institution, and they didn't tell. I'm desperately trying to contact, by the way, the regulators are running for the hills. I know I have dealt with most of them, and they ain't returning phone calls. but because they know what I'm going to ask. But I have a close friend at the who's assistant general counsel of the Federal Reserve Bank of New York, and I'm trying to ask her, what's an eligible institution, and can a small bank borrow against that credit facility? If the answer to that question is yes, then you really don't have anything to worry about, because the banking industry itself is fundamentally sound. It's got lots of capital. Even Silicon Valley Bank was probably technically fundamentally sound and was not, quote, bankrupt, despite its stupidity, of which we could spend hours discussing their stupidity. But unfortunately, as my wife, who's spent 40 years as a criminal defense lawyer, has said, there's no crime called criminal stupidity. But do you have to worry about whether they're going to lift the $250,000 limit on your small bank? The answer is no, I don't think so, except in the extreme case where your small bank happens to be in financial distress. Is your small bank in financial distress? Very unlikely. You can look at their financial statements. They are available probably from the bank, and they are certainly available every quarter from the FDIC. And if you are comfortable reading an income statement and a balance sheet, and there's a lot of drill down. I mean, the quarterly core report that banks are required to file is 55 pages long now. You exclude about 10 pages because it's garbage, but you got a lot of data there. And if you're comfortable reading it, you can look at it and you can tell everybody that you've checked out the financials of your bank and they're fine. And if you're not comfortable reading it, you can ask your accounting firm or anybody else, are they going to issue an opinion letter on it? The answer is no. I certainly wouldn't, but are they willing to help you through it and be comfortable with the fact that the bank has is sound? And the answer is yes, they should be able to do that. And you will find that your bank has a capital ratio that qualifies it as what is legally called well capitalized. It probably has a capital ratio that is a couple points higher than what is required to be well capitalized. I mean, if and there's a couple of different capital ratios. So I don't want to get into what the numbers are, but if one of the numbers is 6% and they're 6.01 and they've been hovering in that point, that doesn't even mean they're close. It may mean they're just fully leveraged. In other words, they've made a lot of loans, and you can look at, how many loans they've made, the loan quality, what's past due. What I did with First Republic, last night took me 10 minutes. What's their securities portfolio look like? How is it classified? Held to maturity versus available for sale? How many loans do they have? What is their cash liquidity, and what is their loan quality? What percentage of their loans are bad loans? And there were a little weak. This is all as of December 31. They do it once a quarter. Their liquidity was a little bit low. Their loan quality was fine. Their capital was a very big number. So I wouldn't be worried, except for short-term liquidity, which is what's going on.
Okay, so one management company expressed, he's got 200 buildings, and he's now shifting, and most of his accounts were with Signature.
Of course they were, because that was their business model.
So he's shifting. He's shifting it to various other banks. Now, is there an easier way? I mean, what is that process to just, I'm now shifting to another bank? That seems like a monumental task, but it has to be done.
Well, no, first of all, it doesn't have to be done. I will tell you, because if you have an account if you're going to shift, shifted to another bank where you have an account. And the reason for that is very simple. Banks are required to undergo what's called KYC investigation. It's know your customer. It's a regulatory requirement. And they have to collect there's certain data that they have to collect. There's certain forms that you have to fill out. For those of you who are familiar with the new Corporate Transparency Act, which requires that every separate legal entity formed under state law report certain information to the federal government about who owns it. Banks have been subject to that rule for COVID +3. I'm not sure exactly how long it is, but I think it was 3 years before COVID. Yeah, that's right. And the banks have to do that. There's certain things they have to do. They have to get a copy of your certificate of incorporation. They have to get they have to find out who your owners are. So you can't open an account at a bank that you have no relationship with in a half an hour. Just not practical. If you have the infrastructure, you can split it between two banks. That may be the solution in many cases. If you have the infrastructure to be able to do that, because you can't open an account. My partners have been trying to open an account at JP Morgan Chase since then, and I checked with my office manager late yesterday afternoon, and they still haven't opened it. Chase still hasn't opened it. Of course, part of that is because lawyers are high-risk customers. That's true, by the way. As a examination policy manual rule, lawyers are high-risk customers because they keep OPM, other people's money. And the joke that I tell, which is not a joke, is that if it weren't for that, nobody would have known that Yasser Arafat used to own Bowmore Lanes. And the answer is yes, the PLO used to own a significant portion of Bowmore Lanes, but they did it through an attorney's escrow account. Therefore, attorneys are high-risk customers. But you should, for this, I don't know offhand whether or not the government regulators have figured out that building managers should also probably be high-risk customers, because they hold anyone who holds what I refer to as OPM, which is other people's money, is considered under the rules to be a high-risk customer. So it may not be so easy for you to open accounts at a new bank.
Okay. Well, at this point, I'd like to ask if there are any further questions. Jay, if you want to wrap it up, but let's just see if anyone raises their hand. Oh, John Minerva.
Oh, good. Oh, he's
Yes.
the guy.
Good morning. Jay, in reference to Signature Bank, they're heavily involved in mortgage lending in our area. How will this all affect the present and future mortgage lending with Signature Bank? Do you have any idea?
I'm going to make what I would characterize as an educated guess. As to existing loans, it's not a guess. Existing loans, no change. You have people, serious business people have said to me, hey, I owe Signature Bank, one guy, $12 million on a couple of mortgage loans. Do I have to keep paying? The answer is yeah. So I would say no effect on current outstanding loans, which brings us to two additional questions. Well, three. One is lines of credit, credit cards, lines of credit, and otherwise, are they going to continue to advance? They have told me that they will. My educated guess, without regard to the fact that I was so told, is yes, they will. Why? Because they don't want to bust their franchise. It has value. And the biggest value in Signature is not the stupidity of their taking deposits from venture capital firms. By the way, they swore, I have in writing that they've never made a loan to a crypto company, and that's just a bad rumor. But the franchise has value, and you don't want to kill the value of the franchise. So my guess is that they're going to continue to lend money on their lines of credit. They have assured us that they are doing that, that credit cards issued, well, actually, they said that credit cards issued by Signature Bank will continue to be honored, but the truth is that Signature Bank has no credit card assets on their balance sheet, which means that they probably issue credit cards, but the actual debt is owned by somebody else. Could be Bank of America, which does a lot of this. So it's kind of like private label credit cards. It's transparent to you, but they're going to continue to be valid and continue to be honored. That brings us to two more questions, which is how about outstanding loan commitments? And how about applications in process that have not yet generated a loan commitment? Outstanding loan commitments, again, in both cases, they've said, yes, 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 we're continuing business as usual. And I am the guy I'm talking to is a senior VP in the lending department. But as to outstanding commitments, they're contracts. And we'll call it bridge signature. Bridge signature is bound by the outstanding contracts based upon the manner in which they have taken over existing signature. And I have no reason to believe that that outstanding commitments will not be honored. And the press release that was issued by the Secretary of the Treasury, the FDIC, and the Federal Reserve on Sunday, it's called the Joint Regulatory Statement, says that one of the principal purposes of this was to not just pay out deposits, but also continue to provide credit to the communities in which they serve. So I believe that all existing commitments will be honored. And how about applications? I have no reason to believe that they will not be honored, because if for no better reason than Signature continues to receive payments on debt securities, continues to receive payments on loans, and they're going to have to redeploy that money. Again, they don't want to kill the franchise. My comment, which I wrote in a blog that I'm about to publish as soon as I have a minute or two, is, yeah, but if you offered cryptocurrency as collateral for your loan and you have an outstanding application, it might not get approved, and you wink, wink, and you should probably consider whether you have any other collateral. John, do you have another question, or did you just not read?
No, that answers. So as far as future lending, that'll depend on who the successor bank is.
Yeah. What I doubt that there will be a major, let's call it immediate, a major short-term shift in the business plan, because they have the infrastructure to make the loans. They know how to make the loans. They don't want to kill the value of their franchise, and whoever acquires them is going to want to realize upon the value of the franchise. Now, if I were an applicant for a loan, and I had, let's say, and I posed it this way, I'm in the middle of a 1031. I've just applied for a loan from Signature Bank to buy the replacement property on a 1031 exchange. What am I going to do? The answer is to tell you, and what I would advise a client, and I'm about to advise people in writing, is I'd go to another bank. I wouldn't get, if I wanted to maintain my relationship with Signature, I wouldn't cancel my loan application with Signature, but I would begin the process of exploring the possibility that I can get my loan somewhere else, because I can't afford to be wrong. You know, I don't want to be on the wrong end of blowing a time limit on a 1031 exchange. But if I, gun to my head, if I had to bet, you'll be okay with signature. But prudence in that, if I have a time is one of the questions that I pose, frankly, on Tuesday is if I have a time is of the essence closing on a real estate transaction and time is of the essence next Monday, am I going to get my money out of signature and what should I do? And my answer on Tuesday was pick up the phone right now and call your loan officer right now and tell him you've heard all these rumors and tell him that they're not funding letters of credit and that they're horrible. And you want to know right now whether you need to go to a hard money lender for emergency financing for a time is of the essence closing on Monday, and find out and listen very carefully to what he says. And if he says something like, well, I got to talk to my supervisor. I'm waiting to hear from the EVP. Run as fast as you can to another lender. But I believe that would be a really dumb. Sorry, my family keeps saying I use the word stupid much too often, so I'm trying to switch it to the word moron. But it would be really, really dumb, and I don't think they're going to do it. But you don't want to be the one guy who's at the end of the line.
Any other questions before we sign off? All right. Well, Jay, any other last statements? You seem to cover every angle here.
Don't panic. My one last statement is don't panic. The only problem we really have, and let me tell you what I told my partners when I was outvoted 9-1. Don't panic. The biggest danger we have now is panic. In 2000, towards the end of 2008, I created a dead pool. Those of you who know what a dead pool is, I don't mean the movie, I mean the wagering system. In which a couple of us made a list of the 10 banks most likely to fail in the United States by the end of the year. I think it was Labor Day weekend. One of them failed before the lists were completed. And I couldn't figure out how to monetize it, except I did make a bet with someone on what was going to be the next bank to fail that was going to be closed on a day other than Friday. And somebody said, how could you possibly know? I said, put up $5 and I'll tell you. And he put up $5 and I said, Liberty Point Bank. And he said, why? I said, because they're dead man walking. They're going to get closed. I know they're going to get closed. And management are all Orthodox Jews, and they're not going to be around over the weekend, and they're not going to be around on Friday afternoon. So they're going to close it on Thursday. Sure enough, they closed it 2 weeks later on Thursday. I couldn't make up a dead pool right now with respect to the banking industry. It's just, there are probably a couple of small institutions floating around the country that are in serious trouble for one reason or another, but the numbers are so tiny that I honestly believe that the biggest problem is panic, or don't.
Illustrated in the Bailey Building and Loan from The Wonderful Life. It's a Wonderful Life.
Yeah, a lot of people are saying if the local communities acted towards their banks like they did towards Bailey Building and Loan, we wouldn't have this problem. And my sort of reductio ad absurdum comment on that is, yeah, if the jerk from the venture capital fund had kept his mouth shut and had not caused panic at Silicon Valley Bank, I'd be spending a hell of a lot more time dealing with the fact that Aaron Rodgers may become the quarterback of the Jets and the timing associated with that, and the different, and I would have read the NBA collective bargaining agreement the NFL collective bargaining agreement much faster than I would have read the FDIC insurance regs. But unfortunately, he caused panic, and that the lemmings all jumped off the edge of the cliff. And we could talk about whether or not the guys who caused the panic. By the way, causing the panic is itself a criminal offense in New York, but it's never been litigated. My belief is that the manner that causing a panic by talking is protected by the First Amendment. It doesn't quite reach the level of shouting fire in a crowded theater.
Mm.
But I suspect there are a lot of people who are looking at that question. And the management of Silicon Valley Bank has been sued. And on that issue, I am only waiting to see whether the lawyers who are representing the plaintiffs understand this well enough. I haven't read the complaint yet, but my guess is that they're practicing law by reading the newspapers, and the complaint is based upon what they've read in the newspapers. And that's all wrong, so we'll have to see.
Okay. Well, that was fabulous.
If anybody wants anything wants me to email you assorted government statements and press releases or regulations, just so that you have it, my email address is there. And if you need any legal help on these issues, there's only one person who really knows how to deal with them. Just kidding, there might be three. And I have to contact the other two because we're going to be doing a presentation on this for the Bar Association next Thursday. We'll all be fine. This too shall pass. It ain't 2008. We know it's not 2008. Nobody should panic.
Right. That's the best. That's the best news.
Right.
Okay. Thank you,
All right.
everyone.
Okay.
Thank you, Mr. Hack, providing us with this critical information about the most current banking issue facing America today. All of you can see on this page at the end of the video his contact information. Please feel free to contact him about your issues or any other member of his firm that would apply to your situation. Thank you. See you soon.